some other concentration risk chart stocks year-to-date relative performance. I mean, we've never had this size concentration risk, for lack of a better word, including this great chart, which is literally record percent of stocks beating the S&P are the smallest ever. You can barely even see it on the screen. I mean, we have such intensity of AI tech, mega cap tech, whatever you want to call it. That's safety. To me, that just says that's a safety trade. They don't dare bid up anything else because the other stuff may not make it, but very likely the big tech with the big moats will make it. Any comments on sustainability as it relates to concentration risk? I know it's right now exciting for those who are in gamma chases, but big picture, it is not sustainable.
This short clip is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, economics advisor, Jeffrey Fouvry, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
Ultimately, we have to get to a situation where we start to break these passive flows that continue to move into the equity market in the US and are just going into SPY. And then that capital that goes in gets allocated by active managers or by quants or whatever. And the better stories keep getting more and more of the capital, and that comes at the expense of the worst stories. And so what is going to break the flow of capital into the equity market is what is going to break that passive flow. It's hard to see it without significant payroll declines, right? Because payroll increases kind of put that 401k contributions into the market at a steady pace. And so we need to see payrolls get hit and people get fired in order to kind of break some of that passive bid for the market. Obviously, there are certain times of the month and certain times of the year when corporate buybacks are less versus more. Right now, obviously less, no corporate buybacks right now. So, now would be a decent time for, if we could get a fundamental catalyst, it could matter more. CTAs are incredibly long. Systematic funds now are incredibly long. So losses there could lead to some more selling. But ultimately, it will only break, I think, when earnings get hit for some of these names. I don't see, there's not going to be a regulatory change. There's not going to be a tax change. There's not going to be some sort of, now this is not, I don't believe this is going to happen, but like if the S&P itself decided to change the rules about how they're going to compose the index, or started to put caps on constituent percentages and said no single name over 5% or something along those lines, then that would be a huge deal. I mean, there's been no talk of that. I don't even know the rules about that, but they should do that. I mean, I don't know why we have an index where we're that's trying to be reflective of the economy that clearly is no longer reflective of the economy and is being gamed. And if they put a cap and said no name over 5% or something like that, or we rebalance every 3 months based on that would be different. So that's probably worth at least understanding the dynamics of whether S&P or the MSCI could change the constituent requirements. There's no momentum on that, but that would be another thing. But other than that, I think it would have to be earnings, and it would be a break in earnings on one of these names that the kind of people said, oh shit, we got it. It's time to sell. And I don't really like what the rest of the economy looks like, so I'm going to take my X% gains for the year, and I'm going to start selling. And I'm going to look at the VIX at the lows, and I'm going to say, yeah, it's time for me to start getting some protection on for the election or for some other stuff in case the Goldman, Barclays, Sequoia thesis is actually accurate. Yeah.
So I have a few levels. It bears watching for darn sure. I've been tracking this Mag 7 ratio, which is literally just the biggest mega cap tech plays, including Tesla, which has definitely been lagging until this April. Now it's up 60% from the lows. But the point is, it is approaching a fib level, which is actually over here, this kind of 131, 132 area. We're almost there. We're kind of at 129 today, for example. And that's where I expect we should have a little bit of chopping or digestion. We made it up to NASDAQ 100, 500 even, and I have a fib level above that, about 505, 507 as an overshoot. Anyway, I think those will time about the same same time, which would be a good kind of technical area for taking chips off. Very much a difficulty in trying to predict when you're in all-time highs, blue skies, but that would be my best bet as to when we start to peter out. And it just so happens to be around earnings. So we're running into earnings, very typical, right? In Mag 7, which is really the only name in town, other than anything related to AI, tech, ecosystem. We've been noticing, Corning and some power producers clearly that are tied to data centers and AI have also ran up beautifully, that are typically seen as not momentum stocks. Long story short, this is where I think it hits its head. So that's what I'm looking for. But again, it's end of August into mid-September. Any comments on that timing? Because that's definitely what I'm looking at for technicals of my stuff, intermarket, plus the option flow. It just looks very much like middle of August to end of September, we're going to get hit.
The full episode is available to Edge paid members. For more information, visit LaDucTrading.com/edge.